This is very, very important. And you can only really understand it if you understand the psychology of bankers. Imagine that you're a director of a bank and you have got loans out to businesses in this environment. And you know that quite a number of the businesses which you have lent money to cannot handle higher interest rates because they are, we could be really blunt and say that they're zombie companies which you've been keeping going because you didn't want to write off your loans. They could be merely businesses which in better times thrive, but when they get a drop in sales, then immediately they start running into overdrafts. So when it comes to that sort of liquidity money, do you really want to provide liquidity into an economy which you can see is beginning to turn down because interest rates are going up? The answer is no. The other thing is that quite a lot of your activities, and particularly since the 1980s, have been increasing in the financial sphere. So you've got a lot of exposure to financial assets. Rising interest rates, what does it do to their values? So that's another area which you're probably going to try and cut back on. So this is a time to be very nervous. And if you were caught, let us say, with COVID, and of course, COVID completely unexpected. What happened? Everybody, their sales stopped, their costs continued, their borrowing increased. So, you suddenly find that you are over-leveraged in a market which suddenly is beginning to decline. Now that, for a banker, is a frightening position to be in.
According to Alasdair Macleod, it seems that as a bank director, you'd want to cut back as much as possible. An interesting point that came up, which Macleod can't recall if it was discussed previously, is that Jamie Dion reportedly said 2 weeks ago, "I liken the economy to being in a storm. I've upgraded that now. As far as I'm concerned, we are in a hurricane." Macleod suggests that this statement from one of the most senior commercial bankers in the world is a clear indication that he's planning to start contracting his balance sheet. This warning should not be ignored, as it implies that bankers worldwide are likely to follow suit, even if they hadn't already reached this conclusion independently. Dion's words seem to have cemented the belief that the situation is worsening, making the contraction of balance sheets inevitable. Macleod goes on to explain that this cycle of bank credit is a recurring phenomenon observed throughout history, notably in the first half of the 19th century. While it smoothed out somewhat after the 1844 Bank Charter Act, it still led to significant economic downturns, such as the post-war slump and the 1930s crisis. These cycles typically occur every 10 years, and it's now been 14 years since the last major downturn, which was primarily financial and led to the Lehman Brothers collapse. Macleod suggests that another downturn may be on the horizon, and as a bank director, one would be highly aware of these dynamics and likely feel very exposed. Furthermore, Macleod points out that if a bank has counterparty risk in the Eurozone and Japanese financial markets, it would be aware that counterparts in those regions are even more highly leveraged. He mentions that the leverage in these foreign banks is quite high, with the G's average in the Eurozone around 20 times and in Japan around 21-22 times. This high level of leverage makes these banks particularly vulnerable to failure. Consequently, according to Macleod, it would be prudent to batten down the hatches, collect as many loans as possible, cut the deposit base, reduce the balance sheet assets to equity ratio, and protect shareholders.
Are we beginning to see in the actual data these deleveraging steps on behalf of the banks? Is that already beginning to appear in the data that you monitor?
It's only really evident in slowing down of the growth. I'm talking sort of worldwide rather than specifically. The slowing down in the growth of broad money supply, which is comprised basically of bank credit and everything which is slightly more liquid. So yes, we are seeing signs of it slowing down, but we haven't yet really got the signs that this is really going to crash. But I have no doubt that in my own mind that is the direction in which it's going.
So you would think that banks would would tighten lending policies, meaning they'd be letting fewer loans, they'd be making fewer loans right now, given their concerns. You would think they would probably trying to call any loans that they could, right?
Yeah.
Just they're not having them out there. I guess this is the type of behavior that you're expecting to see a lot more of over the coming months, correct?
Yes, that's absolutely correct. In fact, you can see it already in the figures issued by NASDAQ on margin debt for financing financial positions or positions in financial assets. I mean, that has been contracting very sharply in recent months. So it's really sort of understanding, what makes people reduce their loan positions. I mean, basically, when you've got a really frothy market and everybody's bullish, it's not the people taking profits, because actually their psychology is we want more. Right. So, inevitably what happens at the top of a market like that, when the loan books start contracting, is that it is the banks driving it, not the punters. And obviously it's not a pure argument. I mean, there's a bit of both, obviously, but I would say that overwhelmingly the banks, the brokers would be pulling in loans rather than the reverse. So when you see, sort of positions beginning to go sour, I think that they would tend to act very, very quickly on the margin in order to try and close positions down. So it's an interesting question, because we tend to think of margin loans only really being on the bull tack, but we do know that hedge funds have been shorting it and recently been squeezed, which is why the equity market has been so strong in the last month or 6 weeks. So, either way creates a loan situation which would be reflected in the NASDAQ figures. But by far the bigger determinant is the use which the public put on that money in terms of its use value. So to give you an example, if they decide to dump the currency completely in return for goods and services, then it becomes completely worthless, despite the changes in the quantity of money which may or may not happen. And I think that at some stage we are likely to see this played out in quite dramatic form. And the reason I say that is that when you get a very severe contraction of bank credit, it inevitably leads to banking failures. It is the job of a central bank to try and ensure that these banking failures do not happen and they do not impact on members of the public. So what you're going to see is the currencies being debauched in order to protect the financial system, if I can put it that way. And I've said this so many times until I'm blue in the face. The prime example of this was John Law in 1720 France, when he printed credit in order to buy support shares in his Mississippi venture.
According to Alasdair Macleod, the current situation appears to be reminiscent of John Law's actions in 1720 France. Macleod reportedly pointed out that Law printed credit to support shares in the Mississippi venture, which ultimately destroyed the currency. He suggests that today, central banks might resort to similar measures, such as money printing, to support financial assets and banks. This could potentially lead to currency devaluation or a loss of credibility. Macleod highlights that major banks are highly leveraged. In such an environment, when the outlook worsens, these banks tend to contract their balance sheets. He noted that this contraction has a significant impact on GDP, which is largely driven by bank credit. With cash making up only 5% and bank credit accounting for 95% of the economy's currency, Macleod believes that a contraction in bank credit could lead to a substantial shrinkage in GDP, possibly by $4 to $6 trillion. This would represent a massive hit, not even considering systemic risks from abroad. Macleod reportedly emphasized the importance of understanding GDP as the sum of transactions funded through bank credit. He argues that a contraction in bank credit will inevitably lead to a contraction in nominal GDP, affecting both the economy and the financial sector. According to him, the potential severity of this contraction cannot be overstated, and it is likely to be far worse than many anticipate.